Hey, welcome in to another episode of the Chris Miles Money Minute here on the Fearless Investor Podcast. This is the second episode that we have done with Chris. And once again, if you do not know, we are starting a series with Chris Miles here, who I believe is one of the smartest investors of our time. And what we're doing is we're giving you free exclusive looks into the mind of Chris Miles and also how he's helping so many people to be able to ditch the financial advisor mindset, ditch the accumulation mindset, and really start to accelerate your life and help you get to retirement early. Like the one thing that we talked about in the last episode a month ago, which by the way, we're putting these on the last Wednesday of every month. So if you are checking this out, this is the last Wednesday of the month. Next one's going to be the last Wednesday of next month. But even in the last episode, we were talking about how this whole idea of accumulation versus acceleration. And really, Chris, like what I loved about what we discussed is that so many people can get to retirement earlier, but just don't even know it. They're not even aware. And just a simple conversation with you, they can understand that. So we're going to give you two opportunities here. I'm going to tell you right now, go to fearlesskyle.com/Chris Miles, and you can fill out a free evaluation with Chris. It takes you 2 minutes, and you can jump on the phone with him for a free 15-minute consultation where he's going to talk about how you can possibly retire earlier too. But with that being said, in that long intro, I want to welcome you in, Chris. Thanks so much for being on the show, man.
Always a pleasure, man.
All right. So I'm excited about today's episode. This is something I've been wanting to talk to our audience about for a long time because you opened my mind up to this. And now it's like, well, duh, like everyone should be doing this, especially those in real estate. And it's this idea of infinite banking. So floor is yours. What is infinite banking?
Yeah, so infinite banking is this tax-free, supercharged savings account, right? But this savings account we're using here is using life insurance, very specifically whole life insurance. There are different types out there, but this one's using whole life. This is different than the traditional whole life policies that you see, right? Most whole life policies, and you got guys like Dave Ramsey out there saying that they suck. Like it's like, do not ever buy it. And even Susie Orman's like, they're a waste of money. Don't buy them. Well, they're kind of right. If you buy the traditional kind, which most people offer, they're not wonderful, right? They take forever to build up cash. Yeah, you're paying mostly the costs and fees and insurances and things like that in the beginning because it's front loaded. So term insurance is like more expensive over time, right? Whole life is the opposite. You pay your insurance costs mostly up front in those first few years, and then it gets easier where you start building cash from years 3 on. But the way I do it is even different and even better than most people that call themselves infinite bankers. Infinite bankers say, hey, let's give you more cash up front, lower the costs, and then you can actually build this as well. So you can actually use this as your own personal bank, right? You can actually use and leverage this money in a way that actually pays you more than just using your savings account, right? So here's the big key difference though. What I do with it is max ROI, lowest cost. Right.
Okay.
So
That's great.
One thing that I'm willing to do that most even insurance guys that do infinite banking won't do, the thing I'm willing to do is that I'm willing to cut those costs down to the minimum possible and get you the max ROI. The reason is because I'm already retired. I don't need the money. But the funny thing is people keep coming back to me because they're like, well, you do the best ones. You design them the best way. And the reason being is that because we want these to be as low cost as possible with max amount of cash going in. Here's the cool thing. You can put in way more than what you put into a Roth. So the way it works is this. One, it is like a savings account because you can access that cash from day one, at least the way I design them, right? Bulk of that cash, whatever you're putting into it. Two, the other thing that's cool is that this is kind of like a Roth IRA, but where it goes in tax-free, you put in after-tax dollars, it grows tax-free, and it comes out tax-free. Here's the cool difference between this and a Roth, where it's better. The Roth, you still have to wait till 59.5 where you get that little penalty, right?
Yep.
Here, there is no 59.5 rule. That's why you can access it from really the first month. You can access that cash. Here's the other thing it's like, the way I use it. It's like a HELOC, right? So a home equity line of credit, you get it, you pay interest to the bank. We all get that. We obviously want to leverage it to go and invest it somewhere that pays us more cash flow than what it costs us on the payment. But the way we use this way is the same thing. The difference is that there is no minimum monthly payment with this life insurance.
Right.
There is a balloon payment due if you never pay it off. It is due at death. So they will take some of your
It's a
death
good
benefit and
time.
pay off the loans, but that's it. So unlike a HELOC, so that's the one thing. There is no minimum monthly payment. So if you're doing short-term investments, flipping and things like that, this is awesome because at least you don't have to pay out of pocket in the meantime.
Right.
But the other thing is cool is that unlike a HELOC, you only pay interest, but the bank doesn't pay you any interest on that HELOC money, right? You have to earn that interest from your investments. The life insurance actually pays you at the same time while you're leveraging it. So they're paying you on that money, tax-free dividends, and you're earning money in your investments. So you're essentially earning money in two places at the same time. And that's what makes it awesome.
And so I just want to quantify this for people because this is what really spoke to me about this whole thing. You know, when I have money sitting around, I get anxious because I'm like, this money should be growing. But I'm also really skeptical about now locking that money up and not having access to it. So when you shared this with me, I was like, okay, great. I have access to the money. So I can go and, you know, if I put, let's call it $50,000 into a life insurance policy, then I can go access the majority of that. It seems like maybe around 85% is what I'm kind of hearing. And I can take that. And now maybe I've got a flip coming up that needs $30,000 of a rehab. And instead of going and raising that money, I just use that of which I have in my whole life insurance policy. I take out that $30,000. But what I loved about this is that I'm still getting paid interest on that full $50,000. That is so powerful because essentially, guys, what that means, and Chris, you can probably explain this a little bit better, but it's like I'm not even taking that money out. I'm paying myself back anyway. I'm loaning the money back to me, and then I'm paying myself back. And from what I understand, I'm getting charged interest when I take out that loan, but I'm getting paid interest on the entire amount as if that full $50,000 was in there. That was the mind-blowing part for me.
Absolutely. Yeah. It's you're double dipping, right? And people are like, wait, how can they do that? Well, yeah, they charge you 5% interest to borrow that money, right? But you're also earning anywhere from like 4.3 all the way up to 6% or whatever, you know, on the other money that's in there, the same money that's in there. So you can access it two different ways. You can either withdraw it just like you would from a savings account. But if you withdraw it, remember, you've lost that opportunity cost. You've lost that ability to earn interest on that money when you withdraw money. That's what's so hard. Like if you withdraw money from your savings account to put into investment, if it's a cash flowing investment, you're having to wait for that cash flow to build up over time to replenish that savings so you can go and invest again. Here we're doing the same thing. We're doing it almost like when you're using a home equity line of credit, right? But you're borrowing from the insurance company, you're paying them interest, but they're also paying you interest on that money too. And you're earning money on the investment. So when the money comes back in, you're just cycling the money through. And I'll give you an example, a real life example. I mean, I ran a scenario where I borrowed like $95,000, right, from my policy. I ran that against doing it from my savings account. So either withdraw 95,000 from my savings account and then use the cash flow from that turnkey property to pay back in. It was like over $1,000 a month. Or two, I use my life insurance policy to borrow from it and do the same thing, right? So the money's still in there, growing tax-free, you know, compounding at like at least 4, 5+% a year tax-free, right? But here's the cool thing. At the end, so about 9 years out, I had $50,000 more cash in my life insurance policy than I would have had in my savings account.
Wow.
This is the same people are saying, buy term and invest the difference, right? I even factor in buying the term. If you've taken the buying the term costs, I'd probably have even more than that, right? Because I still have to pay out of pocket and that money never comes back to me when I buy term. It's like renting a house, you know, where whole life, if you do it right, it's like owning a home and it can appreciate, it can grow, it has tax benefits, all that good stuff.
That's a great way of putting it. It really is like owning something rather than renting something. And I understand term life insurance, especially if you got a family and you've got all, you know, a bunch of dependents. But when it comes down to it, there is a death benefit for this whole life policy as well. So how do you compare those two?
Yeah, it's huge. Like, I mean, just having the death benefit and everything is great, you know, but I mean, that's the bonus, right? The death benefit almost becomes the bonus in this scenario where the cash becomes the hero, you know?
Yeah, absolutely. So what's you know, you mentioned a real life scenario for yourself. What's a real life scenario for maybe one of your clients that is using this infinite banking model and now because of it sees this opportunity to grow their money, retire earlier, And are they using it in real estate? What are they using it in? I would love to hear something like that.
Yeah, there's several examples. One that comes to mind is I had a person that came to me. She was a dentist. She said, "Hey, Chris, so I already got a policy set up. Like, she set up one previously. It wasn't as good as what I designed, but it still was decent. So she borrowed 125,000 of it. She did a real estate deal with her son, so they partnered together on that deal. 1 year later, the deal paid out 155,000. So they basically profited 30 grand from that flip, right?
Great.
So they said, "Hey, all right, we got 155 grand." She's like, "Do I just pay off the 125,000 plus interest, which was like maybe 6 grand?" She's like, "Do I just pay that off, or do I reinvest it? What do I do?" And I said, "Well, how do you already have investment lined up?" She said, "Yeah, like if I pay off the loan, I'll be taken back out a few weeks later." I said, "Well, that's the beautiful thing about the life insurance. You don't even have to pay it off. So if you want, just take that 6,000 that you owed in interest, right? Just pay that off, just so you can keep the money from compounding against you, the interest, right? And then just take that other 150,000 and invest it again, and just turn around and do it again. So I think that's the cool thing, is that the money's still, there's still a loan there, but she doesn't have monthly payments. She can let that money leverage and do whatever she wants, and she's making money on that money too. So, and that's the thing too. I mean, even though she's paying the 6,000 interest, she was still earning tax-free dividends that last year that she made on that 125 plus grand that was in there.
Yeah. Hey guys, just want to pause this episode. This is going to be a two-part series. Chris and I ended up talking a lot about this infinite banking strategy, and I wanted to make sure to give it into bite-sized pieces for you. So right now, we've talked about what it is and really how it works, but in the next episode, we're going to really compare it to other forms of life insurance, because that is the big question. I get that all the time, especially since I've started working with Chris on this and talking to other people about it. Well, term life insurance is better. Oh no, universal life insurance is better. And oh, you can do infinite banking with universal life insurance. And Chris has very strong foundations in which he really believes that whole life insurance done the right way is the best investment vehicle for whatever investment that you're using. And so I really wanted to break that into another episode. So next month, last Wednesday of the month, you're going to be able to see exactly what the difference is. But really, make sure you go to fearlesskyle.com/Chris Miles to get that free evaluation from Chris. He's going to show you how you can be getting to retirement earlier, how you can use some of his strategies or his vehicles that are going to help you to be able to get to your goals quicker. And like, that's the thing, is if you just have money sitting around in a bank account and you're like, what do I do with this? Then Chris is your guy to talk to. So again, fearlesskyle.com/Chris Miles. And next episode, we'll learn the difference between all of those different life insurance policies on the Chris Miles Money Minute. We'll talk to you later.